Level 1. At $10 a month, you're not an investor. You're a data point. Wall Street does not see your face. It sees your user ID in the database of a micro-investing app. The interface is colorful, bright, and gamified. It sends you notifications with emojis when the market moves 1%. This is not for your benefit. It is to keep you engaged with the screen so you don't notice the quiet arithmetic siphoning your capital. If the app charges a $3 monthly subscription fee and you're investing $30, you have just paid a 10% fee before a single share was purchased. The math is elegant in its cruelty. Those who have the least pay the highest percentage to participate. You are buying fractional shares, which means you don't even own a full unit of a company. You own a digital promise held by a middleman. The treatment here is automated neglect. There is no phone number to call. If your account is frozen or your deposit disappears, you speak to a chatbot that repeats the same 4 sentences. You're standing in the digital equivalent of a gas station line, doing mental math to see if your $124.57 balance is working. It isn't. At this level, you're simply a source of order flow. Your small trades are bundled and sold to high-frequency firms who make pennies off your desire to start small. You are the payload for the platform's venture capital valuation. Level 2, you have moved up. You are 32 years old, and your direct deposit is consistent. You are putting $643 into a standard brokerage account every month. You have graduated from the colorful toy apps to a legacy institution. The treatment here is polite indifference. The bank doesn't charge you a subscription fee anymore, but they keep you in the status churn. They offer you basic research reports that are written by AI and distributed to 4 million other people at the same time. You are earning 0.01% on your uninvested cash, while the bank lends it out to level 7 clients for 8%. The spread is the tax you pay for being retail. At this level, Wall Street begins to pitch you mutual funds with 1.2% expense ratios. They don't tell you that this fee will eat 30% of your gains over the next 30 years. They frame it as professional management. It sounds like peace of mind. It is actually a life leak. When you have a problem, you wait on hold for 22 minutes. The person who answers is reading from script. They call you valued, but they don't know your name. You are Path B, the spender. In their eyes, someone who provides the liquidity that keeps the machine running. You are doing the right thing, but you're doing it in a system designed to ensure you remain a customer rather than a sovereign. Your jaw tightens when you see a maintenance fee on a month where the market was down. You're starting to build, but you're still paying for the privilege of holding the hammer. Level 3, at this level, the algorithm shifts. You're no longer just order flow. You are a viable revenue source. Your monthly contribution is north of $2,000, and your total balance is crossing the $100,000 mark. The system notices this pattern, not with a handshake, but with a change in your digital interface. The banner ads for premium gold cards and personalized wealth dashboards start to appear. The treatment here is algorithmic engagement. You get access to a direct line to a customer success team. You aren't speaking to Ren yet, but you are no longer speaking to the chatbot. The person who answers has the authority to waive a $25 wire fee because they can see your total relationship on a single screen. They want to anchor you. They know that if you stay at this level for 5 years, you will eventually become a level 5 client, and they want to ensure you don't take your anchor to a competitor. The invisible ceiling. Here is the advisory fee. Wall Street begins to offer you a managed account for a 1% annual fee. It sounds like a promotion. It sounds like you've made it into the room. But 1% on a $200,000 portfolio is $2,000 a year, money that could have stayed in your index fund. Success at this level must have a cost, and that cost is the temptation to let someone else drive the car. You're a customer, recognized and serviceable, but you're still being managed by a script designed to maximize wallet share. Level 4, you are putting $7,400 a month into the market. You are 38. Your investable assets are climbing toward $500,000. You have reached the prime tier. The treatment shifts from automated to priority. The sensory experience changes. When you call, the hold music is shorter and the voice on the other end is more senior. They don't read from a script. They have override authority. Wall Street starts to treat you with deference. You get invited to Market Outlook webinars hosted by actual analysts, not AI bots. You're offered Lombard loans, the ability to borrow against your stocks at rates that level 2 investors can't see. This is the first time you see the rules become flexible. The bank will give you a $100,000 line of credit at 4.5% interest because they know your $500,000 portfolio is the collateral that makes the deal risk-free for them. However, the tax of this level is the complexity trap. Now that you have capital, the institution tries to move you into alternative investments, private credit or hedge fund-like products with high fees and lockup periods. They are trying to turn your sovereignty back into a product. You are no longer a unit of growth. You are a proven asset. You have the beginning of leverage, but you don't yet have the total discretion of the elite. You are a high-value passenger in a better chair, but you are still on their schedule. Level 5, you are 42. You are deploying a small fortune into the market every 30 days. Your total portfolio has crossed the $1.5 million mark. At this level, the treatment shifts from priority to named. You are no longer a number in a queue. You are a line item in a regional director's quarterly review. The interface is a human being named Run. Run doesn't wait for you to call. Run emails you directly with investment briefs tailored to your tax bracket. The bank recognizes you as an accredited investor, a legal designation that implies you have enough capital to lose it without the government needing to protect you. This opens the door to the black box products, private equity, venture capital, and pre-IPO shares. Wall Street is finally inviting you to the table where the real spread is made. However, the tax at this level is the discretionary fee. The institution wants to manage your global financial map for a percentage of your total wealth. They offer to handle your tax strategy, your estate planning, and your trust structures. It sounds like a partnership. In reality, it is an attempt to anchor your legacy to their balance sheet. The room where you meet Run has better chairs and thicker glass, but the quiet arithmetic is still running. You have sovereignty, but you're being watched by an institution that is terrified of you moving your capital to a competitor. Level 6, you have reached the final tier. Your monthly investment is larger than the annual salary of the person who serviced your account at level 2. You have attained institutional status. At this level, Wall Street stops being a marketplace and becomes your personal infrastructure. The treatment is total deference. You do not use an app. You do not wait on hold. Your family office communicates directly with a lead private banker. The price of money for you is now lower than the rate of inflation. You can borrow $5 million against your portfolio at SOFR plus 1% to buy a commercial building, while the level 2 retail steady is paying 8% for a car loan. This is the wealth dividend of pure capital. You are no longer paying the spread. You are the one extracting it from the system. The experience is one of total control. You aren't being pitched products. You're dictating terms. If you want to move $2 million on a Sunday, the bank makes it happen because your relationship is a named line item worth protecting at all costs. You have achieved the infinite leverage, the ability to live on low-interest debt while your assets compound in a tax-shielded environment. The invisible ceiling has been shattered. You are no longer playing the game. You are the one the game was built to serve. Level 7. At this level, you're no longer investing in the market. You are the market. Your monthly deployment is enough to buy a mid-sized apartment in cash every 30 days. You have crossed into the territory of the institutional sovereign. The treatment here is strategic partnership. Wall Street doesn't send you emails. They send you proposals. You have a dedicated team that includes a tax attorney, a structured finance expert, and a lead banker who answers your calls on the first ring, regardless of the time zone. The sensory experience is defined by total efficiency. You don't provide pay stubs or tax returns for a loan. The bank already has your global financial map and has delegated discretion to your specific account team. The quiet arithmetic has shifted into bespoke credit facilities. You borrow money at LIBOR-based spreads that are razor-thin, rates that are lower than the inflation of the currency you are borrowing in. You're using the bank's money to acquire assets that return 10%, while your debt costs you 3%. This spread is the wealth dividend that was used against you at level 2. Now, you're the one extracting it from the system. Success at this level means the banking system is no longer a cage. It is your personal infrastructure. Level 8, you have reached the final tier. You are an account of significance. Your name is a line item in the bank's annual review, and losing your relationship would be a catastrophic event for the executives. At level 8, the credit score is a historical artifact, a relic of a time when you were vetted by a machine. The treatment is total sovereignty. You do not have a banker. You have a family office and a lead private banker who knows your children's names and your estate's tax shield strategy. The credit extended to you is effectively infinite, limited only by the value of your global holdings. You aren't just getting a good rate. You're dictating the terms. When you want to acquire a company or a $40 million jet, the bank structures a leasing entity that allows you to write off the depreciation against your income. The experience is one of absolute discretion. The rules of retail banking, the waiting periods, the fees, the automated no do not exist for you. The system that was indifferent at level 1, charging Marcus $35 for an overdraft, is now working 24/7 to find legal ways for you to keep more of your capital. You have won the game. You are no longer playing. You are the one the game was built to serve. The balance was $1,140. It always starts there. It always will.